Hello everybody, Tortoise Investing coming at you today with 3 of the best dividend stocks to buy now for long-term compounding growth. These are all 3 really big top dogs in their sectors. Now, if you are new, go ahead, hit that subscribe button for me. Drop a like down below. Those 2 things help the video and the channel out tremendously, and I'd greatly appreciate it. And comment down below. Do you own any of these stocks? Are you looking to buy anything? I'd love to hear from you. None of this financial advice, always your own research for investing. Now, before we take a look at the 3 here, we're going to take a quick look at the portfolio. M1's being a little funny this morning. So this is how things are currently looking in the portfolio. I did buy a little bit more Celsius. They had another dip. Fine by me. I am perfectly fine buying this under 65, and I will continue to DCA into it. Salesforce is one that I wish would pull back a little bit, and I would start to buy some more of it. And then I get paid next Friday, not tomorrow. Next Friday. It's going to come out today, June 27th. I'd love to be able to buy some more MasterCard and United Health. So I'm hoping those stay down, and I will be able to build share counts with those as well. Now, the reason that yens are here. United Healthcare Group Incorporated, I feel, is a very, very strong long-term compounder. Starbucks is another one that I really like, and I think that it is like the top brand when it comes to coffee places. And Vici Properties, probably one of the best REITs out there, I feel, especially for dividend yield and growth over time. This one just knocks both those out of the park. Now, United Healthcare Group, as you've seen, I do own this one. Just free cash flow yield 2.12%, dividend yield 1.74%, and a payout ratio just below 46%. So all those are good things. Take a look here over the last 5 years, up 98.37%. Not too bad. It's kind of been in this rut between about 550 and 430 area. It's kind of been bouncing around there for a hot minute. So I'm taking that as a, I'm going to use this opportunity to build me some shares up. And as long as this thing is below like 490, 500, I feel very comfortable buying it. Again, it's just me. Do your own research before buying anything. Don't just buy it because I got it. Revenue growth over the last 10 years, 11.81%. Pretty good. Take a look here. Revenue by segment. Everything is growing year over year, which is fantastic. People served is also growing, as you see, year over year. It's like the top healthcare insurance, probably the best healthcare company out there. I feel personally, it's just so good. Revenue growth, EBITDA is right in line. The free cash flow is growing at a rate of 15.98%. That is absolutely amazing. EPS is growing 15.81% as well. Very, very good. Take a look here at the debt. They have $54 billion in debt. We'll take a look at quarterly to get update. $63.85 billion in debt. They have $32.71 billion in cash. So plenty of cash on the sidelines. Their EBITDA last year was $36 billion. So no issues there. Usually I don't like companies that have more than 3 times their EBITDA in debt. That shows if something major was to happen, if there was some financial struggles or issues and they had to take out more debt, it would be a lot harder on that company to maintain that like debt to equity ratio, like a good debt to equity ratio, which I feel like they do a good job at juggling. Next up's the dividend, growing at a rate of 18.8% over the last 10 years. The last hike coming in right at 12%, I believe. So again, this just looks like a set of stairs, which is very nice. You don't want a company that's just going to issue like 1-2 cent raises here and there over the long term. You're only getting not even 1%, maybe 2% raise every year out of your companies or your holdings, because then inflation's eating away at it, and it's not true growth. Like if your paycheck, you get a 3% raise every year, but inflation's a 4% for the long term, you're losing 1% of money each year. It doesn't equal out. Next up, we got the share count. It's kind of been even, but it looks like I've started buying back shares a little bit here, which I love to see. 1.26% over the last year. I'd love to see this even more. Again, it's something we can take a look at quarterly and see real quick. And the return on capital employed, it looks like it has been 17-18% for forever and a day. Now let's take a look at the quarterly to see if they're buying back more shares. They are. Yes, do that more. 922 million down from, what was it? Let's see, just a year ago. They were at 943 down to 922. So that's pretty good. I like that. I like that a lot. Next up, Starbucks, the coffee shop in my eyes. You think of, name a coffee shop. Most people are going to say Starbucks. Adjusted free cash flow yield 4.06%, dividend yield 2.88%, the payout ratio just below 62%. Take a look here over 5 years. We're down over a 5-year period. Oh my God, the company's dying. Not really. So there's definitely been some ups and downs with it. I feel a lot of like political things and, union and all that play into the stock price a lot. And I think that this is, a great opportunity. I really like this thing below 80. Take a look here at the revenue. Revenue's grown at a rate of 8.14% over the last 10 years. Very nice. The KPI, this shows their active 90-day members. So this did go down, which is a little worrisome. But again, I think some like political things and then like some union stuff and then just like a whole bunch of other mess possibly attributed to that. So I'm curious to see if this goes down or up the next time they report it. So that's something I'm going to be keeping my eye on for sure next time that they have earnings. Total stores have been growing consistently year over year, which is very nice. Free cash flow is something they could work on. It is trending in the right direction. It's just not a ton of growth. I'd like to see at least, like 10% compounding over the long term. We'll see if it's something they can get sorted out. But they have cash on hand, which is nice. EPS growing at a rate of 10.16% over the last 10 years. Very nice. Up to the right. That's what we like to see. Cash flow. Look like this. Do this. Debt, let's take a look at the quarterly so we can get update. We got $15.55 billion, a little bit over $3 billion in cash on hand. So even with that, their EBITDA is 7.33, so it's just a little bit over 2 times. No problem. The dividend growing at a rate of 15.93% over the last 10 years. It has slowed though, around 7 to 8%. But still inflation beating, and you like to see it, especially over the long term. It looks like they're sticking to that consistent 7-8% dividend hikes, which is good. Shares outstanding. We'll take a look at the return on capital before we do that, but it looks like ROCE is beautiful, 29.21% as of last year. Market average is like 9 to 10%, so this isn't a problem. It's actually very good, very, very good. Quarterly, they are buying back some shares at a rate of 1.5% over the last 10 years. Over the last year, over the last 10 years, right at 3%. I'm hoping on these dips that they're using some of that, cash on hand to buy back some shares. Buy back a ton of these shares. Do it. Alrighty, next up, we've got Vici Properties. This is a REIT, so payout ratio, EPS, stuff like that doesn't really, it's not something to look at for a REIT. You want to look at the funds from operation, make sure they've got good revenue and cash flow growth. So over the last 5 years, Vici's up 27%. This one has been stuck in the mud because of interest rates. REITs are very debt heavy, therefore they rely on interest rates to be low, allowing them to pay that debt off easier. But I still like Vici. They've collected like 100% of their rents, which is crazy. Dividend yield 5.93%, which is very high. I like that a lot. Revenue is growing. It's kind of a newer company. So 69% over the last 10 years. funds from operation, as you can see here, very consistent growth. And I think I did the math on this, and it's going to be like 224, which is about a 6 to 7% increase, which is usually what they do for their dividend. Free cash flow, again, this is trending up and to the right, which you really, really want to see. And the debt, they do have a lot of debt, $16.72 billion in debt. Their EBITDA was 3.38, so it's like 5 times leverage, a little bit less than 5 times. The dividend, though, to have such a high yield and to be able to grow your dividend at a rate of 6 to 7% yearly is just amazing. Look at this over the last 5 years, 7.62%. And they are consistent with this thing. They are committed. Love it. Keep doing it. I think the next dividend is 44.5 cents or something like that. So it's like right in line with right at 7%. And yeah, Vici Properties. If you're looking for a REIT, I couldn't recommend another one more. So very quickly, we'll take a look at the analyst estimates before we go. United Healthcare average 27.72 for the EPS, growing to 29.65, and revenue 398 growing to 429 billion, and Starbucks EPS 360 growing to 421. That's very nice. That's double-digit growth. I like to see that. And revenue is 36.82 billion, growing to 39.96 billion. That's right at 10%. Again, very nice. And Vici revenue growing from 3.81 to 3.94. Again, I think once interest rates and stuff start to get under control, it's going to help retail a lot. It's going to help the entire sector that relies heavily on interest rates. It's going to help them out a ton. That's everything I got for you. Hope you enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, take care. See you.